Hello and welcome to our latest Insider interview. I'm Kyle Caldwell, and today in the studio I have with me Alex Wright, Fund Manager of the Fidelity Special Values Investment Trust. Alex, thank you for coming in today.
Thanks for having me.
Alex, your view is that the UK market's well positioned to weather the US market storm that's been brought about by US President Donald Trump's tariff policies. So could you explain why?
Yeah, so clearly it's been very big news over the sort of last couple of months, the sort of tariff announcements, re-announcements, changes, etc. But I think the UK market and the UK economy is actually reasonably well insulated just because of the makeup of the UK economy and the market. So we're a very service dominated economy. We're not a big exporter. We don't actually have a big sort of trade surplus with the US, unlike the EU or China. And then also, if you look at the makeup of the UK market, it also doesn't have exposure to the type of companies which are badly affected by tariffs. So sort of complex global supply chains like you see in advanced manufacturing, advanced technology. So yeah, like an Apple or a large automaker or a large aerospace company. Stuff's made all over the world, shipped all over the world. So there's multiple sort of tariff barriers and effects of that, which definitely does quite badly affect a number of the biggest companies quoted in the US, some of the big ones that are quoted in Europe, and clearly some of the ones that are quoted in China and Japan, but not really the UK market. So it's not really about UK-US trade deal. It's much more about actually the makeup of the UK economy and the makeup of the UK market that actually makes us reasonably well placed in this world where there's a lot of uncertainty about those tariff levels.
And I understand that you've been strategically adding exposure to UK domestic facing businesses that you think are relatively insulated from tariffs. So could you talk us through which companies you've been buying?
Yeah, so if you think about UK retailers, they import a lot of goods from China, and actually anyone that imports goods from China that isn't the US is actually benefiting from tariffs because it's very uncertain what the tariff levels will be, but any level of tariff makes it less attractive to go to the US, and so gives you more sort of spare capacity to go elsewhere, and therefore sort of potentially lower prices in sourcing. Also, if there's less trade, the prices of actually shipping things from China will also fall. And then you've seen actually the pound be reasonably strong versus the dollar and the RMB, which again makes it sort of cheaper. If you then think about sort of consumers' ability to buy, what that stronger pound means is actually that's good for inflation. Also, globally slower growth maybe means interest rates come down, so it's cheaper to borrow for consumers. And the UK consumer has a high level of savings, so actually there's the ability to actually spend because they've got that pent-up demand. So for a little while, probably over the last 6 months, we've been looking for more plays on this area. We've already had some, the likes of Halfords, Norcross, which are in the portfolio. But two recent new additions would be DFS, the sofas business, and then Frasers, which used to be called Sports Direct, which is a general retailer. And those stocks are at very attractive valuations and I think are benefiting from sort of those trends, which are basically reducing their prices, while at the same time the consumers potentially got more money to spend as interest rates fall.
In the previous video, we talked about your exposure to UK mid-caps and UK small caps, but you do also have exposure to the FTSE 100 index, the larger companies. Could you talk us through the key sectors that you invest in within that index?
So obviously over time it will change on what's attractive, but in terms of sort of where we are today in some of the big stocks and sectors, we've got quite a large weight in tobacco, which is about 7% of the fund across both Imperial and BAT and Staples. Then financials is big. So in fact, overall, that's about 25% of the fund across not just large cap, but mid cap names as well. And that would be both banks, insurers and other financials. And then the big areas that are large in the index that we don't have exposure to or very low exposure would be things like pharmaceuticals, oil and gas, and metals and mining.
As you mentioned, interest rates, they've started to decline and they're expected to decline further, although I think it's very unlikely we're going to return to the days of interest rates being ultra low. How do you then approach your UK banking exposure? Does it make the sector less attractive?
Yeah, so certainly banks, retail banks, so the likes of Lloyds and NatWest, make a lot of their returns from the fact that people have current accounts that don't pay interest, and therefore when interest rates are higher, they make a larger margin than they do when interest rates are low. And clearly ultra low rates are a real problem because it's culturally very difficult to charge people for their current account, but there clearly are costs of running those current accounts and branch networks for the banks. So that was the clear problem through the period of ultra low interest rates. I think as long as interest rates are above 1 or 2%, the banks are able to make a very good return on capital. And we always think about scenarios. So what is this bank worth if interest rates in the future are 1, 2, 3, 4, 5? And think about actually what's the risk reward look like. And I think the banks look very attractive at rates over 2%. Clearly they're not as attractive as they were when they were at sort of 5%, but still very interesting investments. And then also the UK banks, which is quite different from some other banks, particularly say sort of US banks, etc. They have what they call a sort of rolling hedge. So actually the benefits of rates going up, the banks don't just put all the money that you have in a current account on short-term deposit with sort of the Bank of England. Actually what they do is they buy the equivalent of sort of 5-year bonds, and they do that on a sort of rolling basis. So actually it's been less than 5 years since interest rates went up. They only really went up in sort of 2022. So the benefit of that is still coming through in the bank's earnings until 2027. So yes, interest rates are going down, but you won't actually see that in the profits of banks until at least sort of 2028 and onwards. And so you've still got very good returns, very good dividends and buybacks from the banks in the meantime.
I next wanted to ask you about gearing. So investment trusts have the ability to gear or borrow to invest. What are the current gearing levels at the moment, and what's your typical range?
So the range is quite variable. So we have the ability to go up to 30% geared, but the current board limit's about 25, and we've been as high as 20. We've been as low as basically no gearing, and we're at about 7% today. So I'd say that's slightly below the typical levels, and actually reflects the fact that the markets have had a really quite strong run on an absolute basis. So the trust's at an all-time high, the FTSE's at an all-time high, and so particularly some of those larger cap stocks, we have been taking some profit recently, and that's moved the net of the fund down recently.
I was next going to ask you about what would need to happen for you to increase those gearing levels. So I assume the answer may be if there's a pullback in the UK equity market, you would then look to increase gearing as a tactical decision to take advantage of that.
Yeah, and that's very much how, if you look at the fund and how it's worked over time, when was the highest ever gearing? It was the day before we discovered the COVID vaccine, because the market had fallen a lot. And we've been gradually buying more and more stocks as we got more and more confident about actually what was happening on the ground and the value on offer. And then the gearing started to fall again as the market rallied and prices moved back to a more reasonable level. Similarly, when markets fell in early April, we moved the gearing up from about 12 to about 14% as markets fell. And then as markets have rapidly grown back, so again, the fund's performed almost sort of 20% from the bottom, we've taken that gearing back down again. I suppose the more recent period of sort of adding and then taking away has been much tighter than it normally would be, because the market sort of fell so quickly and then rebounded so quickly.
And finally, Alex, I last had you in the studio around 18 months ago, so I know that you do personally invest in Fidelity Special Values. So instead I wanted to ask, when was the last time you bought shares in the investment trust?
So certainly over time, my ownership of the trust has grown as we do invest over time. Actually, the last time I bought was sort of last November because I saw reasonably good valuations and quite a lot of opportunity and a good discount on the trust as well. And we tend to do that. So I wouldn't buy every year, but I do on average sort of probably do add on average every year, but not necessarily in every calendar year.
Alex, thank you for your time today.
Thank you for having me.
So that's it for our latest Insider interview. Hope you've enjoyed it. Let us know what you think. You can comment, like, and for more videos in the series, do hit that subscribe button. And hopefully, I'll see you again next time.